SGX Market Overview. The Singapore Exchange entered a highly selective consolidation phase to kick off the trading week, as local equity benchmarks digested recent multi-week record highs amid a broader global technology valuation reset. Following a spectacular structural run earlier in the month, the market opened Monday's session on a quietly optimistic note, with the Straits Times Index climbing 6.68 points in early morning trade to touch an initial intraday peak of 5,516.11. However, as the trading session progressed, institutional profit-taking picked up pace, matching defensive risk reduction strategies observed across regional Asian hubs. The benchmark Straits Times Index ultimately drifted lower by 10.48 points, or 0.19%, settling at the 5,498.95 mark at the closing bell, hovering just a fraction below the critical 5,500 psychological baseline. Aggregate volume metrics confirmed that institutional participation remains deeply focused, with total daily securities market turnover expanding to 1.20 billion shares, accumulating a solid transaction value of 2.10 billion Singapore dollars. Market breadth leaned safely toward the decliners, with 365 stocks finishing in negative territory against 226 advancing counters, proving that portfolio managers are heavily rebalancing portfolios ahead of the high-stakes corporate earnings season. The central narrative of today's price action revolved around Singapore's powerhouse banking complex, which continues to trade near historic valuation frontiers following a massive multi-month capital influx. Portfolio allocators executed minor profit-taking maneuvers across the trio, balancing long-term dividend upside against demanding near-term price-to-earnings multiples. DBS Group Holdings, which recently printed an extraordinary milestone by crossing the 200 billion Singapore dollar market capitalization threshold, retreated a marginal 0.72% to close at $71.96. Overseas Chinese Banking Corporation drifted lower by 0.76% to settle at $28.56, following an impressive multi-day run that saw the lender surge over 4% last week. Meanwhile, United Overseas Bank experienced the heaviest institutional rotation among the financial heavyweights, sliding 2.37% to finish the session at $42.47. Despite the daily downward adjustments, macro research briefs show that institutional support for the banking trio remains fundamentally anchored by their fortress-like balance sheets, outstanding common equity Tier 1 ratios fixed near 17%, and dominant global wealth management fee pipelines. Allocators view the minor pullbacks as a healthy correction, providing key capital re-entry windows for income-focused portfolios ahead of upcoming distribution announcements. Moving into individual corporate performance layers, global semiconductor spending anxieties and overseas competition triggers created significant headwinds for domestic tech hardware infrastructure providers. Automated testing equipment innovator AEM Holdings faced severe institutional selling, tumbling a sharp 5.78% to close at 8.64 Singapore dollars, as fund managers lowered growth expectations across the artificial intelligence testing supply chain. In complete contrast, telecommunications giant Singtel provided a clinic in defensive excellence, completely bucking the negative index trend to advance 1.14%, closing the session at $4.44 on robust institutional volume. Singtel continues to attract deep-pocketed defensive capital as portfolio managers aggressively reallocate capital into companies displaying highly predictable, transparent cash flows and expanding digital infrastructure footprints across the region. Concurrently, the real estate investment trust sector, or S-REITs, demonstrated resilient pockets of income safety. Commercial heavyweights led the defensive accumulation, with Capitaland Ascendas REIT climbing 1.21% to $2.51, while Capitaland Integrated Commercial Trust added 0.82% to close at $2.47, proving that income allocators are prioritizing top-tier institutional commercial property portfolios to insulate against global macro shocks. As we map out trading strategies for the upcoming sessions, institutional risk management requires a rigorous evaluation of imminent fundamental catalysts and technical chart boundaries. Technically, the Straits Times Index remains securely positioned within a structural bull market, with the 5,480 to 5,500 demand tier expected to act as an immediate structural floor during any short-term consolidation. The forward corporate calendar is exceptionally dense, triggering critical valuation checkpoints over the next 72 hours. Investors must closely monitor the ex-dividend date for SATs Limited, alongside high-stakes global earnings prints from Alphabet and Tesla, which will heavily dictate the trajectory of regional technology sentiments. Furthermore, the back half of the week will see vital local earnings updates from Keppel SREIT, Mapletree Industrial Trust, and Suntech REIT, giving allocators concrete data on current S-REIT operational margins. We advise maintaining a highly disciplined, premium-biased asset allocation strategy. Continue to build defensive hedges within institutional large-cap banks and telecommunications leaders, while systematically collecting high-quality commercial property trusts that exhibit robust capital management structures. That concludes the Singapore market update. We will see you at the next opening bell.